It is the era of dividend cuts. First, the pandemic forced companies to cut payouts by 12% in 2020, slashing investor cash return by $220 billion. Another 232 companies cut their dividend last year, lowering dividends by a combined $15.2 billion. And the pain continues this year, with heavyweights like Intel, Rite-Aid and MPW. Investors are being lured in by the promise of high-yield cash return, only to get the rug pulled out from under them as dividends and share prices plunge lower, leaving you not wanting to sell at a loss, but also not collecting the dividends you need. Fortunately, I found 7 dividend stocks with a high yield and, more importantly, the safety to know the dividend will keep paying out. I'm going to reveal those 7 high-yield stocks along with how I found these and how to avoid dividend cuts. I highlighted WP Carey, ticker WPC, recently in a video on the Dividend Champions, one of my favorite real estate stocks with a 6.5% dividend yield. And the fact that a 6.5% dividend yield is the lowest on our list gives you an idea of how high this is going. WPC is a $17 billion REIT with a great diversification by property type. In fact, pretty evenly spread across industrial, warehouse, office, and retail space. Most of the property is in the United States, though it does hold just over 35% of the properties in Europe, which gives it great geographical diversification. And that diversification is really why I like WPC as one of my favorite dividend REITs to start a portfolio. Against the other real estate stocks I follow, only WP Carey has the exposure to different property types that I believe can really bring down the risk in your portfolio. The company collects over $1.1 billion in annualized base rent and books 98% occupancy over 131 million square feet across more than 1,100 properties. WP Carey has topped expectations for funds from operations over the last 4 quarters, reporting an FFO of $5.20 over the last year, so trading for about 12 times on a price to FFO basis, which we can see here in this NAREIT data. That price to funds from operations is very low compared to other long-term averages around 16 times. WP Carey is a part of the Dividend Champions group of stocks, companies that have increased their dividend payments for at least 25 consecutive years. In fact, WPC just makes the list with 26 years of rising payments. We're just getting started, but I wanted to highlight a special offer from one of the sites I use for dividend research. I use the premium features on Seeking Alpha for my research on all my stocks, but it's especially powerful for dividends. I can see yields, dividend growth, and safety, but best of all, under the Estimates tab, I can see estimates for how much a stock is going to pay in dividends over the next 2 years. It's a great way to plan my cash flow from dividends. Use the link I'll leave in the description below. Try it out risk-free for 7 days. If you like it, the link is also going to give you a special promo code for $50 off that premium access. Next up on our dividend list, a value play in Leggett & Platt, ticker LEG, and it's 6.7% dividend. Now, you might be familiar with the Dividend Aristocrats or the Champions, both groups with 25 years of increasing dividend payments. Leggett is a dividend king, those companies with more than 50 years of increasing their dividends. Leggett is a global leader in manufactured components for home and auto, including bedding, furniture, flooring, and industrial parts. More than 60% of the sales are from the home segment, with nearly half of that from bedding. The company does have some diversification, though, with 35% of its sales outside the US, and 40% in the auto and industrial segment. Now, with the housing market correction and the slump in auto sales, earnings for the company have been hit hard. Profits are expected to fall 30% to $1.53 per share this year on a 5.7% drop in sales. Now, that's probably going to mean that the company is going to have to put on debt to keep up that $1.84 per share dividends, plus however much it grows it to keep up with that 50-plus year tradition. And that would normally worry me about a dividend cut, but the company has $316 million in cash, and earnings are expected to bounce back next year. The board gave us a signal of its confidence with its dividend increase just last June, and the valuation is very attractive here. Shares are trading for just 0.78 times sales, a discount of 13% from its longer-term average. If business does improve over the next year, the stock price will reward investors along with that dividend, but the risk is higher in this one compared to some of the others on the list. Main Street Capital, ticker MAIN, with its 6.9% dividend, is our first monthly dividend stock on the list, paying you every month to hold the shares. Main Street is a business development corporation, a BDC, specializing in loans and equity investments into mid-sized businesses, with shares producing a 9.2% annual return over the last 5 years, and all this while other BDCs have cut their dividend. Main Street has managed its dividend gradually higher with special dividends as well. The main dividend has increased 105% since the 2008 IPO, and instead of shooting it higher when times are good, the company pays out that supplementary dividends as a bonus. You see, business development corporations pay out at least 90% of their profits to keep a special tax break from the government. That means dividends jump at other BDCs, but then they run into cash flow troubles in a rough economy and have to cut that dividend again. Main Street is more disciplined, though, saving some of that money back for that supplemental dividend, and that's why it is a safety stock among BDCs. The company has 182 portfolio investments as of the most recent quarter, with the largest representing just 3% of the total fair value. That's important because it means a hit to any individual investment isn't going to hurt the company too much. The weighted average yield on the portfolio of loans is 9.6%, so well above that dividend yield, giving this one sustainability and room to grow. We've got another stock from the Dividend Champions list up next, but I can't just drop a list of stocks in your lap. Nation, I do not want you relying on some YouTuber for stock ideas. I want you to be a better investor, so I want to show you how to look for safety in your dividend stocks. We'll do this on Seeking Alpha here because it's easy to find these measures, but you can do this on just about any investing platform. I'll use AT&T as an example, and you'll see why, even with its 7.5% dividend yield, it didn't make the list for safety. Now, clicking through to dividends, we can see these category grades for safety and consistency, with AT&T scoring a C and an F, but I don't want you relying just on these. The measures I'm going to show you are easy to find and will help you understand the stocks better rather than just relying on some overall arbitrary grade. So if we go to the dividend safety tab, the first thing here is the dividend payout ratio. It's the annual dividend per share amount divided by the company's earnings or profits per share. And that's one of the best measures you can use because obviously a company cannot pay out more than it earns. It says here AT&T pays 44% of its earnings out, and there are a few things you want to compare this against. First, compare it against the sector median, and we do see that AT&T pays out more than the others in its sector. That could mean the company is stretching to make that payment. Next, looking at the 5-year average, we see that the company is paying much less than that 61% of its earnings it used to need to cover the dividend. And we do know that the dividend was cut last year for exactly this reason, so it could save more of those earnings for reinvestment in the business. So the payout ratio is high, but not dangerously high, given that the company has pulled back quite a bit from where it was. On the dividend growth tab, we can see that the dividend is lower on a 3, 5, and 10-year period. We can also see that the free cash flow per share has grown at a negative rate. Now, a company with a falling free cash flow will eventually need to cut that dividend. Again, you can find this on any platform, including Yahoo Finance, for free. Take the annual dividend amount and divide by the earnings per share for that payout ratio. Here on the historical data tab, you can see the history of dividend growths or cuts. We see AT&T's dividend cut last year as well as the complete dividend history. Finally, here on the cash flow statement under financials, pay close attention to this free cash flow amount, and one, that it's growing year over year, but also that it's enough to cover that dividend amount without the company having to borrow money. Our next dividend stock is one of the highest yielding dividend champions, Enterprise Products Partners, ticker EPD, with its 7.5% yield. EPD is a fully integrated midstream company, meaning it has that exposure to energy to everything between explorers and retailers, including 50,000 miles of pipelines, storage, gas processing, and chemicals. It's more diversified than most other midstream energy companies and has the financial weight to leverage that size for higher returns. Return on invested capital has remained well over 10% even in the worst collapse in oil prices, so you've got a dividend stock you don't have to worry about. Now, dividend growth here hasn't set the world on fire at just 3% a year over the last 5 years, but their shares have produced a 7.8% annualized return. The company just made the Dividend Champions list with 25 consecutive years of dividend increases and is going to be one to own for a long time. Our last 3 dividend stocks pay an average 9.7% dividend and have produced some of the best cash flow, but I wanted to give a shout out to a few honorable mentions here that didn't make the list. Mostly because I know if I don't, I'm going to hear about it in the comments. Because the first is everyone's favorite monthly dividend stock, Realty Income, ticker O, with its 5.5% yield. The real estate owner of convenience and retail stores is part of the dividend aristocrats, and in fact, just booked its 122nd dividend increase since going public in 1994. It is an unbroken track record and cash flow you can count on, but that 5.5% yield didn't quite meet the cutoff for high yield on our list. 3M, ticker MMM, also missed that cutoff with just a 5.6% dividend yield, even though the stock is part of the Dividend Kings list, with an amazing 64 consecutive years raising its dividend. I am a little worried about that track record, with the company posting negative 2.6% organic growth across the business last quarter, and only the healthcare segment saw positive growth. The company pays out 65% of its earnings as the dividend, which is approaching that dangerous level, but even if the dividend is safe, it's only grown at a 2% annual rate over the last 5 years. Hardly something that is going to grow your cash flow. Now, 3M is finalizing a spinoff of its healthcare segment for the end of this year that could be a positive catalyst for the stock price short term, but likely won't fix those long-term growth issues. Back to our list though, and next is the highest yielding dividend king, Altria Group, ticker MO, with its 8.9% dividend yield and 53 years of consecutive increases. The owner of the Marlboro brand here in the United States is driving hard to a smoke-free future with heated tobacco and pouch products, and has been able to keep revenue consistent despite a years-long trend of lower cigarette volumes. You see here, even against an annual drop of 4% in cigarette volumes, the company has been able to stem that to just 1.7% on growth in e-vapor and oral products. Altria also owns a 10% stake in the beer maker Anheuser-Busch, worth $10 billion for some serious cash flow. Even on that continued long-term drop in volume, Altria had the pricing power and the cash flow to pay down $1.1 billion in debt and still buy back $2.1 billion in shares and pay $6.4 billion in dividends. Now, the payout ratio is getting a little high here at 79%, but earnings are expected 5% higher next year. The company has been able to grow the dividend by 6% annually over the last 5 years and should be able to keep up that 4 or 5% growth. It might have to slow the share repurchase program a little bit, but that 8% yield and the dividend growth makes this one a safe and solid investment. Aries Capital Corporation, ticker ARCC, is another business development corporation paying a 9.9% dividend yield. Now, like we saw with Main Street Capital, Aries uses that special dividend strategy to keep its regular dividends from jumping around like other BDCs. It's paid out 6 special dividends totaling 16 cents a share since 2019, and has increased that regular dividend at a 4.7% annual pace. Again, here we see the safety of diversification in the company's loans and equity investments across asset classes and just about every industry. It's a little more heavily focused on tech and healthcare, but still that level of diversification I like to see. Another important point when you're looking at these business development corporations is looking in the financial statements for the weighted average portfolio yield. Now, that's the average return on the company books from its loans made to other businesses and is a key measure of dividend sustainability. Here we see that Aries reported an 11% average yield last quarter, so not only is that above the dividend yield it's paying, but it's also improving well above that 9% yield it reported last year. Aries has a backlog of deals worth over $425 million to refill that loan and equity position, so it should be able to keep that cash flow running and have no problem growing the dividend. We're coming up on my favorite high-yield dividend stock, but some of the best cash flow investments aren't necessarily the highest paying. In fact, I've made an average 49% return on my dividend portfolio, with some paying as low as 3.4% dividend. Check out this video where I rank all 12 of my dividend stocks from best to worst. And my favorite high-yield dividend stock isn't a stock at all, but an ETF, the Jepi Morgan Equity Income Fund, ticker JEPI, and its 10.3% dividend. The fund invests in defensive, large-cap stocks like insurers, consumer staples, and pharmaceuticals. You see here, it's all those bellwether stocks like AbbVie, Coca-Cola, and United Health. And that gives it safety when the market tumbles. Then the portfolio managers sell call options on the S&P 500, that broad stock market index, to generate the cash flow for its dividends. That puts it in a class similar with those other ETFs, like the NASDAQ 100 Covered Call ETF, the QYLD, with its 8.6% yield, and the S&P 500 Covered Call ETF, the XYLD, with its 8.4% yield. But the difference is the portfolio manager team at JP Morgan, with over 60 years of experience in equities and derivatives, and the ability to sustain that dividend while still protecting the share price. You see that experience in a chart of the price returns on the JEPI versus these other popular covered call funds, including the QYLD, the NUSI, and the XYLD. The JEPI has lost just 0.88% over the last 2 years versus losses of 30 and 33% in the NUSI and the QYLD, even a loss of 15% in the XYLD. The JP Morgan Fund has produced a solid 7.5% annualized return over the last 5 years, and while the dividend has jumped around, rising and falling more than individual stocks, just simply because it's a fund holding stocks, something that you would expect, it's still able to maintain that strong double-digit yield. Get your 7-day free trial and $50 off promo code to Seeking Alpha Premium with the link below, Or click on the video to the right to see all 12 dividend stocks in my portfolio ranked from best to worst. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.